All right, so I'm going to try to go through Yellen's comments here and kind of parse them out and give you some context or explanation of what I think she's talking about. So she mentioned that rate increases are going to continue. They're going to be gradual, but she did not think they would need to go up much further to reach a neutral rate, whatever that is. A neutral rate is a totally arbitrary construct in the minds of the Fed officials, apparently. I have no idea what a neutral rate is or what they base that upon. She did not say, and this was something I mentioned in an earlier email, which I did not have full clarification. She did not say, that's it, the Fed has decided it will not raise interest rates. Now the distinction between a statement like that and saying that she did not think that rates would have to rise much further to achieve a neutral rate, I mean, that's a huge distinction. If the Fed came out today and said, that's it, we're not raising rates anymore, then a lot of my outlook then kind of comes into question. I mean, the bullish gold outlook, the bearish dollar outlook, because of course, as I have been saying, since the Fed began with its rate hikes back in December of 2015, I said that rate hikes are inflationary. They raise the general price level and they constitute fiscal expansions, all else equal. Since the government is a net payer of interest, when the Fed raises rates, necessarily it is spending more money. So if the Fed says, that's it, we're not raising rates anymore, then the whole price scenario, the inflation scenario, that kind of goes or shifts into neutral. It doesn't go down. If the Fed said, now we're cutting rates, that's a different story. So that's number one, some clarification there. Number two, she said that the Fed was going to move ahead in unwinding its balance sheet this year and said that, you know, the balance sheet will be appreciably lower than where it is now. Now, that is very, very significant. Remember, all the inflationistas and all the wackos and the kooks like Schiff and Mark Faber Printemani and Jim Rogers, you know, they all got it wrong with the extraordinary monetary policies and quantitative easing when they were predicting hyperinflation and a collapse in the dollar. They all got it wrong because they didn't understand what that was. When the Fed does those things, it's basically a gigantic asset swap. And in the case of when it was buying assets, when it was buying treasuries and other assets, it was removing high-yielding assets from the economy and replacing it with reserve balances in the banking system that paid nothing. So it was stripping the economy of income, and you could see it very clearly if you look at personal interest income in the GDP numbers. You know, that dropped by over 200 billion in the time that the Fed was doing that. It's taken out. Now, the reduction in the balance sheet, it does the opposite. It takes away the low-yielding assets, which are reserve balances, and it gives the economy back those higher-yielding assets in the form of treasuries or mortgage-backed securities, all right? So you're pumping in that extra income without taking away any, without increasing the economy's output. You're just pumping up the income. So that's inflationary. So the way I read this, okay, and there's a lot of turmoil in the market today. I'm going to get to the Bank of Canada in a second. The way I read this is that we're still on course. Everything is on course. The statement that she thinks they're going to be near a neutral rate, well, that's just her assessment. I mean, she still said the Fed is going to be monitoring conditions. But at the same time, the shifting towards unwinding the balance sheet, that's phase 2 of pumping up the inflation numbers, all right? So the whole thing remains. The gold trade remains, the short treasury remains, the short dollar remains, all that stuff remains in place. So now on to the Bank of Canada. They raised the rates. So now you have another central bank. Before it was only the Fed. Now you have another central bank. So one by one, they're starting to hop on the bandwagon with the rate hikes. So all this fiscal expansions you're starting to see. It's, by the way, probably positive for the stock market fundamentally, but at least to a point. But you don't know how the zombies are going to react. I mean, they might see the unwinding of the Fed balance sheet as something terrible, and they're going to want to take profits. I don't know anymore. All I know is I follow the numbers every day. There has been a slowdown in the fiscal flows, although in the last week, I would say the fiscal flows have picked up. I would say in July, they have picked up. Not enormously, but they have picked up. All right. The best hedge, if you are, short the stock market or cautious or bear, the best hedge right now is that short treasury position. So that is my update on that. The move towards unwinding the balance sheet, having stated that now, the Fed having unequivocally stated that is going to happen. That's phase 2 in the inflation scenario. All right. So that is my outlook. Just keep that in mind. We will see how that plays out, but I'm pretty sure that I have it correct. See you later. Bye-bye.